You walk into a bank with $1,000. Nothing dramatic, just a normal deposit. You hand it over. They type a few numbers. You leave. But something strange just happened. That same $1,000 now exists in two places at once. Your account says you still have it, and the bank is about to lend it to someone else. Not tomorrow. Not after checking a vault. Right now. This is not a loophole. It's not a bug. It's the system. And once you see it clearly, it becomes very hard to unsee. We tend to imagine money as something solid. Printed. Countable. Stored somewhere. Gold bars in vaults. Cash in drawers. But in reality, most money today isn't printed at all. It's typed into existence. And the institutions doing most of that typing are not central banks. They're commercial banks. The same ones holding your salary, your savings, your future plans. So the real question isn't what is money? It's who gets to create it, and how. Because right now, the answer is more unsettling than most people expect. Let's go back to that $1,000. You deposit it. The bank doesn't lock it away. Instead, they keep a fraction. Maybe 10%. Sometimes less. And the rest? They lend it out. To a home buyer. A business. A credit card user. That loan becomes new money in the economy. Because when the borrower receives it, they can spend it. And whoever receives that payment, deposits it again. Now the process repeats. Another fraction held. Another loan created. Another deposit. Layer by layer, like a financial echo. Your original $1,000 starts multiplying. $1,000 becomes $2,000. Then $5,000. Then $10,000. Not because new cash was printed, but because new claims on money were created. This is called fractional reserve banking. But the name almost hides how powerful it really is. Because what's actually happening is simpler. Banks are expanding the money supply by making loans. Here's where it gets more interesting. Banks don't actually wait for deposits before lending. That's the part most people get wrong. In modern banking, lending often comes first. Deposits come after. A bank approves a loan. They don't go check if someone else's money is available. They simply credit the borrower's account. Numbers appear. New money exists. Out of almost nothing. Later, they balance things behind the scenes. Through reserves. Through interbank systems. Through central bank support. But the creation moment? That's immediate. It's not constrained the way people think. Pause for a second. Because this flips the usual story. We're told banks take deposits and then lend them. Like a middleman. But in reality, banks are more like creators. They manufacture money and then look for deposits to stabilize it. That's a very different role. And it carries very different consequences. Let's put numbers to it. Imagine a bank issues a $100,000 mortgage. They don't move $100,000 from someone else's savings. They type $100,000 into the borrower's account. Now the borrower buys a house. The seller deposits that money into another bank. That bank now has new deposits and can issue new loans. So one mortgage can ripple outward into multiple layers of new money. The system grows not linearly, but exponentially. As long as lending continues. As long as confidence holds. And that word matters. Confidence. Because the entire system rests on it. You believe your bank balance is real. Spendable. Accessible. But technically, it's a promise. A liability of the bank. If everyone shows up at once and asks for their money, the bank cannot deliver. Not because it's mismanaged, but because it was never designed to. The system assumes most people won't ask at the same time. That trust becomes the foundation. Not cash. Not gold. Trust. This is where the quiet tension starts to build. Because if banks can create money through lending, then what happens when they stop? Money creation slows down. Economic activity contracts. Businesses struggle to get financing. People cut spending. And suddenly, the system feels tight. Not because money disappeared physically, but because fewer loans are being created. Less new money is entering circulation. So growth stalls. Now reverse it. When banks are optimistic, they lend aggressively. More mortgages. More credit. More business loans. Money supply expands. Asset prices rise. Everything feels easier. Until it doesn't. Because eventually, those loans need to be repaid. And when they are, the money effectively disappears. Loan created money. Loan destroyed money. That's the cycle. Expansion and contraction. Breathing in and out. But not always smoothly. This is where things get uncomfortable. Because banks don't just create money. They decide where it goes. And that shapes the entire economy. If most lending flows into real estate, housing prices rise. If it flows into financial markets, stocks inflate. If it bypasses small businesses, growth becomes uneven. So money creation isn't neutral. It has direction. And that direction determines who benefits and who doesn't. There's also a subtle asymmetry. When banks create money, they earn interest on it. But they didn't have to earn that money first. They created the principal and still collect interest on top. Over time, this builds a system where debt grows alongside money. In fact, most money in circulation today exists because someone, somewhere, is in debt. That's the underlying structure. Money equals debt. Remove the debt, and much of the money disappears with it. Now zoom out. This system isn't new. It evolved over centuries. From goldsmiths issuing receipts to modern digital banking networks. Each step made money more abstract, more flexible, more scalable, and arguably more fragile. Because the further money moves from physical reality, the more it depends on collective belief. Central banks sit on top of this structure. They don't create most money directly, but they influence the conditions. Interest rates, reserve requirements, liquidity injections. They guide the system, but they don't fully control it. Commercial banks still make the day-to-day decisions. Who gets a loan? Who doesn't? At what price? Under what risk? So power is distributed, but not evenly. This creates a strange dynamic. When times are good, credit expands, money grows, assets inflate, confidence rises. But when something breaks, suddenly the same system tightens. Credit freezes, money creation slows, and central banks step in, lower rates, provide liquidity, stabilize banks. Because if banks stop creating money, the system itself starts to shrink. Think about that for a moment. The health of the economy depends heavily on private institutions continuing to create debt. Not just managing money, creating it. That's a different kind of dependency. And yet, from the outside, it all looks ordinary. You check your balance. You tap your card. You transfer funds. It feels stable, predictable, almost mechanical. But underneath, there's constant expansion and contraction, creation and destruction, driven by lending decisions, driven by risk appetite, driven by expectations about the future. There's also an irony here. We worry about governments printing money, but most money isn't printed by governments at all. It's created quietly, through everyday banking activity, mortgages, car loans, business credit lines, small decisions, repeated millions of times. That's where the bulk of money comes from. So when people ask, where does money come from? The honest answer is not a place. It's a process tied to debt, to confidence, to institutions that operate mostly in the background. And once you understand that, a few things start to look different. Rising house prices aren't just about demand. They're about credit availability. Economic booms aren't just productivity. They're about expanding balance sheets. Crises aren't just shocks. They're contractions in money creation, which brings us back to the beginning. You deposited $1,000. Nothing unusual. But that simple act, plugged into a system that can multiply money far beyond the original amount. A system that can expand wealth, and also amplify risk. A system that relies on trust, but operates on leverage. And maybe the most unsettling part is this. If most money is created through lending, and lending depends on expectations about the future, then the entire system is built not just on what exists today, but on what we believe will exist tomorrow. Growth, income, Stability, promises about the future, turned into money in the present. So the next time you look at your bank balance, it's worth asking a slightly different question. Not just how much money is there, but how much of this exists because someone, somewhere, owes something. And more importantly, what happens if those expectations start to change?